integrated concept in Berkeley. And so, yeah, I'm very excited to be here, and look forward to sharing some insights on how to structure deals, the whole range of deals, from entitlements and creative conversions and new construction and typical renovation projects.
Hey, can you hear me? I'm Nagendra. I'm the Chief Credit Officer and part of the executive team at Conventus. We're super excited to be here, and we appreciate this opportunity. Jeff has been one of our oldest and our best clients, and I think he can tell you that one of the things we're excited about is enabling you guys to make amazing investments, and we're really excited. We have my background is that I worked on Wall Street for 15 years or something like that, which is where I met our CEO Keith Tomeo, who met Jeff, and Keith and I had been trading mortgages and distressed mortgages after the crisis, and did decently well on that. And then when Keith started Conventus 3.5 years ago, I came on board to help with not only the loan operation side, but also we have a fund where we hold loans, and then we've also done our own investments in fix and flips and things like that in the multifamily and single family space. So we have a decent amount of knowledge around that, as well as what's going on in the market. So happy to share here.
Here we go. So being flanked by these two guys reminds me of just a couple anecdotes I can't help but tell. So the first time I met Kris was actually the first of these kinds of events that Jay ran. It was in San Francisco. This was like 5 years ago. And I think you were fresh out of Fortune Builders, and I met you, and you were doing just right out of the gate, like 3, 4, 5 really big rehabs, not quite scrape and build, but heavy construction additions in Oakland. You had so many balls in the air, and I'd been doing this for a little bit, but I remember meeting Kris and just thinking, wow, this guy is either gonna crash and burn real hard, or he is gonna crush it. So he's sitting up here, so he's not here to tell the story about how he crashed and burned, or I don't think he would have gotten the invite. So he crushed it, he's got a good origin story and knows his stuff. And as far as Nagendra goes, and more specifically Conventus, like Nagendra said, I started working with Conventus pretty early on, and they haven't been, how long have y'all been around for?
3.5 years.
3.5 years. So it was maybe 3 years and, 2 months ago that I met Keith Tomeo, and I asked him to do this deal for me, and it wasn't like I was asking for $10 million or anything. I was looking for a loan for like $800,000 or something. And I remember asking him if he could do it, and he said, well, if you want the funds this week, I can do it. But next week, I'm not sure I'm gonna have the money. And now, he was like Keith and 2 people at Conventus, and now you guys have like 40 people or something?
That's right.
Yeah, so they just, I can't say enough about it. I'm not being paid to plug them or anything, but they do good work, and they'll bend over backward to make stuff happen. So to the origin, there are a lot of people. I know a lot of people here are local. A lot of people probably just starting out. I've talked to a ton of people here, and I've always met a lot of people at my meetups. Say, hey, how do I get to be doing what you're doing? How did you start out? What's the first move? And everybody's new at first, even though I've been where all of you are, and looked up here on the stage and thought, oh my God, that'll never be me. But it's, none of us are rocket scientists or anything. We maybe have some knowledge you haven't gained yet, but there are no really big secrets. But let's hear Kris. What's your story? What's advice, let's say, for somebody who's kind of new and wants to, I want to be like Kris?
Sure. So I knew real estate was going to be an amazing vehicle to build wealth. That was kind of a no-brainer, and I knew I had to figure out how to get into it. I basically went out and started looking for ways to actually learn how to invest in real estate, and hearing the radio that I'm sure you've all heard with Van Merrill and Fortune Builders, advertising the 3-day workshop that they do. That's really kind of what drew me in to say, okay, somebody's out there teaching how to get into real estate. I didn't realize that they were basically just teaching how to fix and flip and wholesale residential deals. But hey, that's a great start, right? Because it's a smaller bite-sized deal that most anybody can figure out how to take on. I was working in finance at SunPower, which is a solar energy developer here in the Bay Area. And so I had already had a very strong understanding of financial modeling and understanding how to actually project out profitability and figuring out how to structure deals. Although Fortune Builders really opened my eyes to how to, for example, secure debt against a piece of property, and to promise basically not only a primary lender, the hard money lender guys in particular, but also private lenders to be able to secure the amount of debt that I needed. And then it was a matter of finding partners out there who would be willing to partner with me to cover the rest of the money that I would need to pull off the deal, where I was basically willing to give out a good chunk of the deal to bring them into the mix when I didn't have that money on hand. So that really opened my eyes to how to actually get started. At the same time, I realized quickly, probably after the first 8 flips, that there's a whole range of different development strategies that you can pursue to really create more transformative value, right? So think fix and flips. You can create incremental value, right? You make something look better, but it's not fundamentally changing the use or changing what's actually there entirely. And that's what really kind of started to spark my interest, is how to actually get something much higher and better approved through the city and actually try and build something. So I started pursuing a lot of development deals, entitlement deals, where I was securing a development site that had the potential, for example, to support up to 40 units on that site when it was just an existing or former gas station. And so I had to start figuring out how to structure those deals, which really started opening up the creativity in my mind to actually figuring out how to get deals done, because lenders will be looking at primarily 2 things. What are you acquiring? What is the asset that they're going to secure their loan against? And then what are you actually proposing to do? And what is the future value going to be? Right, so when you're proposing a former gas station, for example, and with very kind of ragtag operations on site, and you want to get approvals for an entitlement, they tend to not want to do that, right? Because it's uncertain, and lenders hate uncertainty, right? So what you have to basically figure out, and what I had to figure out, was how to actually start to bring in equity partners when I had to close the gap from a 50 or 60% loan to value loan, right? And I had to still cover the remainder of the purchase and all the soft costs to get the entitlements. Now we basically tripled our equity investment, or doubled our equity investment in that deal, but it wouldn't have happened, and one of my former partners is in the room here in that particular deal, but we had to basically figure out how to structure deals more creatively with equity in particular. And that's kind of now scaled to other deals that I'm doing now, where they are, for example, like a conversion, an existing vacant commercial building that doesn't have any operations in it, and I want to fundamentally change its use. On that particular deal, the entitlements were already secured, and so once you have the entitlements, then lenders get more willing to lend you the construction financing that you need, or I need to actually build the thing with my partner. So, really, at the end of the day, you have to think about what lenders are willing to lend, both against the asset that you're proposing to them and the strategy that you're going to pursue, whether it's entitlement, whether it's renovation or conversion or ground-up construction, and all tied to you as a sponsor, right? So you have to get very clear on who you are and what you're capable of doing, and especially if you are pursuing something slightly riskier, and you have to basically sell them on the story of your certainty of being able to create the value that you're proposing.
So, to follow up, so Nikendra, can you say, you've worked with Kris, you've worked with me, you've worked with a bunch of people in this room, what sort of stuff are you guys looking for in terms of the operator, the project? What kind of things do you fund? What sorts of things will you not fund? What are red flags for you when someone's coming and looking for money for a specific kind of project?
Yeah, so first and foremost, we want to look at the borrower and their experience as a sponsor and their business plan, just as Kris mentioned, and then we look at the as-is value of the property. So we know that you have a plan that you're going to execute upon, and we try to figure out the probability that you will successfully do it. And when you have a more robust business plan where you've thought about the numbers, you've thought about the asset, you've thought about the comps that you're looking at, that makes our job way easy for us to, like you said, bend over backwards and try to structure a deal that really works. I think that, we've started off with like Jeff, for example, with just regular way purchase money, fix and flips, and as Jeff has done more and more complicated and interesting projects, as Kris talked about, we've been able to grow with him to figure out ways to add value. So, for example, Jeff did a TIC deal in San Francisco recently, and we had never really looked at a TIC deal. Jeff's been a great client, and we wanted to make sure that we could retain that business. He's been obviously a great operator in the fix and flip side, and we felt very confident with the business plan that he had and with the partners that he was bringing in on the TIC, that he had a solid business plan. He had purchased the asset at a great value, and we were able to get behind that to not only work on a pretty interesting project that not a lot of lenders are doing now, but also figure out ways in the back end to structure it so that it worked for him and worked for us. Yeah, I agree with you. It's all about that business plan, understanding the financials, the comps, and the as-is value, and then how you intend to execute upon it, and the partners that you have. Another big thing that we think about, especially this time in the market when things have started to soften a little bit, is your skin in the game and how much we're aligned with you in the project. We 100% welcome equity investors and other things like that, but if you come to the table with no skin in the game, it changes the way that we think about the risk of the deal and the risk of the loan. And so, do we just change LTVs and pricing differently for that?
What I really appreciated, I just closed a deal with Conventus about a month and a half ago. And what I really appreciated about getting their term sheet was, the willingness that they have to do third-party debt or equity behind them. And so a lot of, as we all know here, in order to get deals done, you need to raise most, if not all, of the money that you need to do the deal. And so, the willingness that they have to actually work with us, and at the same time, their pricing did change, because I did bring third-party debt into the equation behind them. So, if you're, as a sponsor of a deal, you have to be certain that the numbers are going to pencil out and that your future value is going to be sufficient to basically pay off all the debt that you're taking on. So as a sponsor, they're typically looking at what is your total cost and how much are they lending on the total cost of the acquisition and the construction. They're also looking at future value and their total loan to future value, which I'm actually more concerned with from my own risk perspective, because I need to be sure that the amount of debt that I'm taking on, if it's 100% of everything, I need to be sure that my future value is going to be, or the loan to future value is going to be probably 70%, right? Because I am confident enough that I'm going to create enough value in the process to refinance out both them and any of the third-party equity or the third-party debt that I bring on. So, that's something really important to focus on. And one thing that they required me to do was basically buy a $5,000 appraisal from CBRE, who would basically do an extensive underwriting process of my business plan and to basically opine on that future value that I'm proposing given that use. So, not only was that it was an expense to me up front that I had to pay for, they didn't pay for that. It's something that both gave me certainty on what I was proposing based upon the income generation and the cap rate that they would use to value the property on the back end, but it also gave them the certainty that they could actually loan 80% of the purchase and 100% of the renovation budget that I had in mind. So, yes, it's an expense up front, but it can give you and your investors and your lenders a lot of certainty to move forward with that deal, because, somebody who has no vested interest in the deal has actually put a real number down on paper that you can rely upon.
Yeah, there's one thing that I add to that, which is the appraisals from those type of parties. We manage that whole process for you. But we've had cases where we've ordered appraisals like that, and clients have come back and said, "Oh wow, this project actually doesn't make as much sense as I thought," or it makes way more sense than I ever thought it would, coming from a reputable bona fide shop like CBRE or Colliers or Cushman & Wakefield. The second thing that I would add is that we've done an extensive analysis of all of our borrowers and just try to figure out, how much are they making in their returns on average, their return on invested capital. So the total amount of money they spend from the purchase to the rehab to the interest cost and financing costs and taxes and insurance and all those things. And it turns out that that number on average is in the high teens, like 18.5%. There are folks like Jeff who average well above that, which is amazing. And a lot of that comes from buying the right asset at the right price. And so I would encourage you that, as you're going out there and trying to look at deals, think about that number as kind of a benchmark of where you probably like to be, on a return on invested capital standpoint, and think about all those different costs that might go into it.
Yeah, so to expand on that a little bit, just the process of finding money, finding people who are willing to work with you over and over again, having a lender who will sit next to you and say nice things about you. This is, it's all a relationship business, right? And it's a marathon, it's not a sprint. Nobody's gonna retire on one turn of the wheel or one deal, okay? And the idea of Kris saying, hey, I had to do this $5,000 appraisal. On the one hand, yeah, that's an expensive appraisal. On the other hand, in the grand scheme of things, it's nothing, right? Even confined within that one deal, it's really nothing. If $5,000 is nothing on one of your deals, it's not a deal, right? And to build the trust and relationship and have somebody like Nagendra and Conventus say, oh yeah, this guy knows his stuff, that just allows you, and I know it has allowed me, to just, I can come up with a deal. I know it's a deal, it's gonna work. I shoot it over to these guys and they know me, we have a relationship. They're not vetting it super hard, they trust me now. I mean, the first time around, it's always a little different when you're getting money from somebody the first time. I remember, I think it was that first deal I talked about, and I was wanting to, get a first from Conventus, and then I was coming with a private money second, and Keith's question was, are you putting any money into this deal at all? And as it turned out, I was. But that was the first and last time that question was asked. Because then I started getting a track record, and I said, yeah, this is what I'm doing, this is how I'm doing it, and yes, I'm getting a second, and this is how much it's for, and it was, okay, it's rubber stamp, you'll have your money in a week. And so you got to get to the point you're building that relationship. Don't trick anybody, massage, you're not going to fool anybody. I mean, there's a saying, a lot of people will say, when they're trying to find money, the response is, oh, if you have a deal, you'll find the money. Like, yeah, I don't know, maybe. If you have no money and no relationships and you have a deal and you've got a week to close, it could be an amazing deal, but it still might be a little challenging to find the money. So you should kind of lay the groundwork in advance, right, to build relationships. And sometimes, especially if you're new, you don't have a track record, nobody knows you from Adam, they may not want to throw you money, and a good place to start is, it worked for me anyway, really early on, just going to friends and family. These are people who ideally trust you already, and they're more willing to give you the benefit of the doubt, and then after that you can build the track record. Or if you're new also, you've got a deal, and you need to bring in a partner to get someone like Conventus to work with you, you can borrow somebody else's experience, it doesn't have to be yours. And then after you get through that first deal with the lender, then the next time around, you're that person we did business with. And then you can come in on your own and bring the deal, and you're ready to go.
Definitely. Yeah, and tying into that, right, thinking about how to structure a deal from a sponsor's perspective, you have to put your feet in their shoes and really understand what risk that you're bringing to the table. So if you have a lack of track record or you have a lack of construction, right, you're going to have to think about bringing on a strategic partner to underwrite what you don't have. So, finding strategic partners either from money or from construction experience, and that's what I've been leading with in this latest conversion, because it's a very complex deal. It's a two-story brick building, and we've had to retrofit and do all these grade beams to support the two-story brick building. We're basically building a steel frame inside of the building. It's an extremely complicated structural exercise. And so when I was going out and raising capital for that deal, I looked at my network and found a partner who could be a co-sponsor with me. And we basically together guaranteed the loan from them. And they're now not only underwriting my experience, but they're underwriting his experience and his net worth when they're willing to invest in that deal. Now, one thing I want to point out is that the most expensive money that you can get is equity, right? So debt is, I hate to say it, but a little bit of a commodity, right? And even if it's expensive money, it's 10% plus money. Yes, that's expensive, but it's going to be a lot cheaper to get that money than give out any portion of the pie, right? So to bring on a strategic partner and to basically make them a 50-50 partner, you're basically giving up 50% of your upside, right? That's far more expensive than getting 100% of the money that you need at 10%. Or, and in the case that the deal I just closed with them, bringing on a second position lender who is maybe twice as expensive as them, but is willing to give me all the money that I need to get the deal done. Even 20% money is still cheaper, at least, depending upon your deal, is still cheaper than any portion of the pie, any portion of the equity chunk, the share of the profits in the deal itself. So you just have to kind of, look within and make sure that you feel confident in being able to either guarantee and borrow all the money that you need, or, take a little bit of a hit, and a significant hit potentially, in giving out a chunk of the pie, basically the profit share, because you might not be able to actually execute it yourself. So it's a constant risk and reward exercise that you have to internalize yourself, as well as understand what your lender is going to be going through in terms of their process to make sure that they're comfortable lending you that money, whether they're in first position or second position or something else.
Yeah, there are some borrowers who are first-time borrowers or more inexperienced borrowers that come to us, and when we look at their deal, we do our own analysis of a deal even before looking at appraisal or BPO or anything like that. And there are times when the deal looks good from a return on equity perspective, but because they want to lever the deal with a lot of debt, and it looks really great, it seems like I can find investors to take on this amazing return on equity. But one of the things that I would caution against is that you're building a track record and a reputation, so it might work because the market is doing really well, but if there was a blip in the market or a bump that came, that return on equity can go to zero really, really quickly. And so you want to make sure when you're looking at deals, again, is one, try to find a great deal at the right price that's going to give you a total return on invested capital that is really good. And then if that's the case, then you can probably get a decent amount of leverage on the deal. But if a deal has a very thin return on invested capital, in like the single digits or something like that, and the way you're trying to get returns for you and your investors just by putting all the leverage on it, it's a strategy that might work. But if things were to go sour or slow down, that's not going to be great for you and your track record over time with finding capital.
I got a question for you then. So how much would you recommend that somebody stress test their profitability in order to feel confident in being able to pull off a deal? Like within a year, for example, how much could the market really fluctuate? Is it 20% dip where you'd still be safe in your mind? Like, what is the elasticity of the market that would actually put me at risk?
I'm going to actually turn that over to Jeff because he does a great job thinking about this exact thing, and I'll add on the back of that. But from a sponsor, I think you might want to hear what he thinks and how he looks at it.
All right, so I'm not, this is, I guess, a philosophy. It's not really hard numbers or anything like that. It's just, if you got to know your market. If you know your market, you can tell to some extent which way the wind is blowing or which way the wind should blow. And if you want to last, I know so many people really, and we all do, really good investors too, who just got wrecked in the last downturn. They were just overexposed, and they were, they were killing it until they weren't killing it. And that's my biggest fear, right? I've had a good few years here, but I also am very cognizant of the fact that I've had a tailwind that has helped. And at least I have known enough to know that, yeah, I had a tailwind that helped. And because some deal that I had penciled out that looked like it was going to be a double ended up being a grand slam doesn't make me a genius, right? Because the market went up while I was holding. I mean, I put myself in a decent position. I'm only doing deals where I know the exit is easy, desirable areas and all that. But you really don't want to be one of those people who's crushing it, despite the fact that, oh, your contractor flaked on you and screwed you, and you had all these cost overruns, and the permitting took 6 months instead of 2, and then you come out the end and you made a killing and got bailed out. That doesn't make you smart, it makes you lucky. Okay, and you need to learn from that and realize I was just lucky. And you really, again, when you're like underwriting your own deals and thinking about the numbers, just be realistic. If there's appreciation, that's a bonus, it's great, but you need to really run your numbers, because this is how your lender's gonna run the numbers. You need to think in terms of today. What does today look like? And anything you get appreciation over time, that's a bonus. But in a market like now, I mean, I don't have a crystal ball, I could be wrong, but there are a lot of smart people I know who think, and I think too, the party's looking like it may be ending soon. And this idea of, yay, the market went up 15% in the 6 months I was holding, that's unrealistic. And not even now, I'm thinking not so much, hey, what's it worth today? I'm thinking, well, it's probably gonna be worth, it could be worth 5 or 10% less in a few months. And I need to think in those terms. And I've always been driven, and more so now, by not so much running my little spreadsheet, having numbers spit out and go, wow, look at what the gain can be. I pressure test it and think, wow, if the shit really hits the fan, how bad can it get? And if the answer is, oh, it's not too bad, I should still do fine, that's really the cut. And if the answer is not, it's not too bad and I'll still do fine, I'm not gonna do the deal, right? And I can look back and I know there are things that I left on the table. There are deals I passed on that I know people in this room ended up doing, and they did real well. But at the time, it didn't make sense to me. I passed on it, such is life. But with this strategy, I think I'm safe, knock on wood. I think my lenders are safe, because you've got to be, you got to take care of your lenders. You've got to pay people back all the time. And for me, the numbers here at the Bay Area are big. You can get a really good deal and still have a few $100,000s of gap to fill. But still, I've got, and this I guess is sort of industry standard quote, I will do a first, and then I'll do private money second behind it, but I will not go above 75% of the ARV. And that's for stuff that I'm in and out of stuff within a few months. If I have something more than 6 months, something went wrong. And if anything's gonna go longer than that, I know it's gonna go longer than that, I won't even go to 75, I'll go less. And that usually means me kicking in all or most of the rehab, maybe even some money to close, depending upon what kind of deal I got, because I'm also really conservative with my ARV. If the ARV is 1.6 to 1.8, I'm going to self-underwrite on the 1.6, and that's what my 75% of ARV line of demarcation is based on. And my thought is, okay, my plan is to be in and out of this thing within 6 months. I'm gonna finish the rehab, I have conservative numbers, and things can really go south, and at a minimum, I can at least pay everybody back. I may not make money, but I live to fight another day, right? And it's a marathon, it's not a sprint. It's not the end of the world if you don't kill it on every deal, or even if you break even on every deal, or even lose a little. Just make sure you're in a position where you're not gonna get so wiped out that you can't pay your lenders off, because then it's a small world and the game's over.
Two points that come up for me when you describe those things. One is it reminded me why I got out of residential real estate, right? Because there's one exit strategy, right? You have to sell it. In a market like this, at least. I mean, some markets you can end up putting a renter in place to be able to generate enough income to cover your debt, but more than likely not, especially in a supply-constrained environment like this. So commercial real estate has at least 3, if not 4, exit strategies to either continue to hold the asset once it's stabilized in terms of its income generation, right? You can stabilize, or you can finish it and sell it without leasing it up. You can finish it, lease it up, then sell it. Or you can finish it, lease it up, then refinance with a bridge loan, right? Where they're not necessarily looking at the debt service coverage ratio. They're just making sure that the thing is generating enough cash to at least pay the debt that you're putting in place to get all those original people out. Or you can then try and refinance with a permanent loan from a more conventional bank source and then try and basically have the long-term financing in place. But to have basically 4 different strategies that I can exercise if the deal is not going exactly as I planned, if I spent more money and my debt or my total cost to value is too low to be able to refinance out, sell it, right? And realize that gain. And most of the time it's going to be longer than a year. The deals that I'm doing are typically, and so I'm actually paying less taxes because I've held it for a year with the intention, and that's the key piece here, is that I have the intention of holding it so I can claim long-term capital gains on an asset like that. So, I just, as a developer, love optionality, and in residential real estate, you have very little options, right? You sell it right after you're done with it. And so to rely on a market exit as your only way out is risky because the market can fluctuate. When you're talking about commercial real estate, you're really, there's a couple of main factors that you have to keep in mind. One is the rental market. Are the people going to be there to be able to rent the space that you're going to be able to provide? And that has less variability in my mind than someone willing to put down their entire life savings on buying a piece of property. And 2, the underwriting criteria of the takeout lender. Right, so Conventus is not a takeout lender. They're going to be lending me the acquisition and the renovation money, and they expect to be taken out by either a sale or a new lender. Right, so the risk that I am facing is, will that future lender crunch their underwriting criteria where they're going to be able to extend less debt to, and my expectation is to try and refinance out the total cost of the deal with the new debt in place and all the income that's coming in to service that new loan. So, again, just to put a shout out for commercial real estate, there's a lot more optionality that you have at your disposal. And the other piece that Jeff was making is, putting a first and a second in place in a deal and then having to come up with the equity. Now, one thing I wasn't taught in Fortune Builders and many other groups is how to actually raise different types of equity. Because you can, most people don't realize that, obviously you're leveraging with debt, but you can also leverage with equity and different types of equity. And the biggest differentiator in the equity stack is basically who has priority interest, right? The lenders always have priority payoff, right? They've got a secured interest, you got to pay them off in first, in second, and third, whatever priority position that they have against the deed. But you can also do that in your LLC. Right? And if you're syndicating a deal, you can basically bring on equity partners that are preferred equity partners, right? So essentially, it looks like debt in the sense that they get paid off after all the debt's been paid off, but you don't have to promise them a piece of that pie, right? So you can say, look, you get the first capital back, you get your return of capital, and then you get your first return of capital, or on capital, excuse me, before I get paid any of my profit. And from the lender's perspective, typically that still looks like equity because it's not secured financing. It's not secured behind them. So you can still go to the lender and say, look, we're bringing in this amount of equity. And yes, they're probably going to ask you, well, is that your equity? And you can say, well, it's my partner. It's my partner's equity. Because at that point, they're my partner. They're in the LLC with me. Even though they're not necessarily a manager, they're in a member position in the LLC, where they don't have day-to-day decision-making rights. They only have basically the economic interest that they're going to realize first. And then after trying to raise all of that preferred equity, then I would start thinking about giving a piece of the pie, a piece of the profit share. And if I have to boost their return by giving them a minority slice of the pie, you just have to think about who you're raising money from. Right, so the people that you're raising money from, if they are, I don't want to say unsophisticated, but if they're not institutional investors and they're not expecting a crazy return on their capital, if they're self-directed IRA investors who are expecting a 10% return, give them a 20% return and target the return, the annual return that you're able to deliver to them with confidence without actually having to bring in any of the profit share potentially, right? So you say, you get the first 20% on your money and then I get the rest, right? Before you actually give out that pie, unless you need a co-sponsor, right? And that kind of, it circles back to the debt, where they basically say, we need guarantors of this loan. We need to be paid off, and we're going to be looking at you, your track record, your net worth, your liquidity, right? So if you don't have those components, you need to bring on that strategic partner and give a portion of the pie, because now they're basically going to be guaranteeing the debt with you. So those co-managers or the managing members that you bring into the deal to give out a piece of the pie, that's really to circle back to secure the debt necessary in place. But think about the different types of equity, and preferred equity is a great way to structure it, and just make sure that you're consulting with the right attorneys that you need to put them in place and to secure their investment correctly. And essentially that's a syndication. And I'm more exploring syndications for development rather than investment, which is typically the types of syndications that we're talking about in these forms.
All right, so let's see. We have a few minutes left, and I know we have a breakout session, but I know not everybody in this room is going to be in that room. So I was going to open this up for questions from anyone. If anyone has any questions about anything we've discussed so far. Yes?
So what are the different structures that you use, and what is your preferred structure to get into a deal?
What's your preferred structure to get into a deal?
And what are the structures that, on your table?
Yeah.
That you will pick and choose from?
The toolkit.
Why would you go into a certain structure
Sure.
into a deal?
So a certain... Okay, go ahead.
Okay, so question again was, what are the different kind of options that we have at our disposal to be able to structure a deal properly? And Jeff already mentioned the TIC, right? So a tenant in common deal is a great structure where you're basically going to proportionally share directly in the title of the property itself without creating a new LLC. So it'll be Smart Growth Inc., quotation 50%, and Kylor Investments, quotation 50%, and you own the title itself. That's a great deal structure because it lessens the amount of administration costs that you're going to be incurring to set up the LLC. But if you're raising third-party equity, you really need to put an LLC in place because you're essentially securing their investment with membership interest in the LLC itself. So essentially, it's one step removed from owning the property, but you create an LLC that owns the property directly, and then your investors own interest in the LLC that solely owns that piece of property. So when you're bringing on third-party equity, you really do need to have an LLC in place. Or if you have an LLC that's a joint venture with your strategic partner, and you know that you're going to be exposing yourself to greater liability. For example, if you're selling to a consumer, I would create an LLC so there's some asset protection in that. With a TIC, I like that structure better for like an entitlement play, where I'm going to be selling to a developer or an investor, and they're going to be less litigious than selling to a consumer, right? So one layer of asset protection in my mind is better in that sense. And so those are the different, you have TIC, you have a joint venture LLC, or you have a syndicated LLC that are kind of, in my mind, the three main vehicles that you can pursue to structure a deal. And then again, it's like, how much first position debt can I get? So I look to max out what Conventus can give me, and then consider bringing on second position debt, and then consider bringing on preferred equity, and then finally giving up some of the common equity. And so it's always kind of like working my way back to figure out how I can get this deal done with the least amount of my own capital in place. One person I posted on the WOVA app before, and they had said, well, how do you convince your equity partners if you don't have any real cash in the deal? And I had said that you can actually add fees into your deal as well. You could add an acquisition fee or a deal structuring fee, say 1% of the purchase price up front, that you can essentially contribute back into the deal, or your management fee over time to manage the deal. So you can add in some fees, don't get crazy with it, but you can add those fees in, not take that cash out, but then contribute that basically back into the deal, where essentially you're going to get taxed on those fees that you're earning, even though it's going right back into the deal. So just a kind of an interesting tidbit to think about how to structure and to convince everybody that you do have real skin in the game. And sometimes, and I always put in the money that I need to cover any overages in my original projected budget. So, I'm always the backstop, and I'm always basically, the first one willing to continue to service the debt or fund the overages in the deal.
So you're structuring all of your stuff as syndications basically these days?
No.
No, you're not.
No, so sometimes it's 100% debt, sometimes it's a syndicated LLC, sometimes it's a TIC deal, like on an entitlement play that we have in Fruitvale. So really, again, it depends on the risk profile of every single deal and the type of equity that I need and the type of debt that I need to actually pull it off.
Well, you often do combinations of all 2, 3. You might have the first position debt, maybe even second, then do sort of a syndication model for the remainder, chopped up in various ways you just described. That's cool. We need to talk.
Yeah. I mean, maybe sometimes I get too creative when it comes to this kind of stuff, but there's a whole plethora of options out there to structure it properly.
No, that's all good because I'm, you mentioned it too that equity. Giving people equity is expensive. I just avoid it like the plague unless I absolutely positively. It's better to have part of something than all of nothing, but I am always in search of ways to have more of something than give people equity.
Right, and what I would say is that anybody who asks for a piece of the pie, try and shift the conversation away from that to then say, what type of return are you expecting, right? Are you getting a 10% return on your IRA right now? Okay, I'll give you a 20% return, and get away as fast as you can, redirect the attention to what percentage of the pie that they're getting, and promise them that they will get, or project, don't promise, right? Because it's not a promise when you're talking about equity. It's a projection, because they're basically in the deal with you. With these guys, it's a promise. You have to pay them that money, or else they take your asset. But focus on the investor returns as opposed to the percentage equity share that they get.
One thing I'd add there is that, if you're just getting involved, you've done a bunch of residential, single-family fix and flips, and you're trying to go towards a more complicated entitlement play in commercial, for example, it might be worth that first deal, especially if it's a great deal, and you don't have the money and you have to go get the money and have people trust you that you can execute, is to, you're just going to give up a little more of the economics of the deal. For example, when we raised our first fund, we'd managed money before. We'd never, raised money on behalf. We basically gave all the economics to our investors. We literally made zero money for like a year on it. And that was just so we could get the track record and, get that money in so we could do more things in the long term that we wanted to do. And, it took a year. We delivered the returns and everything that we said we would. And thereafter, we were able to get more economics for ourselves. So it might be that first deal was just, getting your feet wet and quote unquote paying your dues. But if you do it well and you do it right, people are always looking for good deals. Like everyone's looking for a good return. And so, again, think about it as a marathon and not a sprint.
That was an institutional investor that you raised that money from?
These are high net worth. There was like 2 billionaires and we were trying to raise from.
So, in that position, again, given the sophistication and the net worth of the people that you're requiring, you're going to be more of a term taker, right? They're going to basically say, here, either take these terms or, we'll see you later. That's why it's like you have to, now it's a lot easier for them to go to one party and say, we need $500 million, right? Where you invest that money and you've got one stop versus, raising 500, $1 million investors, right? Like the effort and brain damage that goes into that is a lot less, but you're going to pay for that in the sense of actually giving up the deal. And it's probably some sort of waterfall structure, which we don't have to get into now, but you just keep that. There's an even more creative and dynamic way to structure your deals where it's essentially a waterfall where as the deal gets more and more profitable, the share of the profit goes proportional to the different, either the money or the managers. And so, that's really how the institutional level investors do it. You can kind of bring that into the picture in your deals too, but that just might complicate things to the people that you're appealing to and just say, look, I'll give you a 20% return on your money, period.
Any other follow-up?
So I think you base on the future value of the asset that you're,
I think you base on the future value of the asset that you're projecting to be able to land a certain amount of money, right? asking question from the lender's perspective. So from the acquisitions point of view, in the beginning of it, you're lending probably above, that's the cost of the asset plus there's a projected, building costs and things like that. How do you protect yourself? Because if the project doesn't go through, to the end, stuck in the middle, then you may need to take the asset back. How do you protect yourself? What are the ways you can protect yourself?
Yeah, so we start out by looking at the as-is value of the asset, what it is today, and we lend against that value. In the case that nothing else happens in terms of renovation or entitlements or anything like that, if we had to take the asset back, we know we're still protected, just based on the as-is value. And then as we lend renovation costs or rehab costs, entitlement, soft costs in some cases when we lend those funds, we're just making sure that that's all in place in the ground. So we have our own construction team in-house that we've hired, who analyzes budgets and draw requests and make sure that all of what you said you've spent on has actually been spent and put in place in the asset. And then, at the beginning, we do an ARV analysis to figure out what the future value of the asset is, and we have a range of outcomes. We place probabilities on those ranges and say, here's the expected value, and we'll lend a maximum amount of debt up to, it's usually about 70% of ARV. That's kind of how we try to protect ourselves. The last thing is just, again, basically based on the sponsor and our assessment of their probability to actually achieve that future value.
Just one point about future value. As a developer and someone who's pursuing entitlements, right, there's actually two future values that I'm considering. One future value at the end of the entitlement, what another developer would pay me for that entitlement to then build it, to go through the construction phase, right? Because in the development process, there's the entitlement phase, then there's the construction phase, then there's the operations phase of the asset. So one thing that really irks me is that lenders, and I haven't met hardly any lenders who will actually underwrite the future value of the entitlement in how they pursue a deal. They'll look at the future value of the completed project, but it's and I've kind of come up with a relatively simple financial model in my developer academy that basically projects out the future value of the built building after you've gotten the approvals and constructed it, but then actually brings it back down to what is the value after the entitlement for that developer to still make a good return on their capital. Right, so there's actually a predictable way in my mind, and yet lenders haven't yet gotten comfortable with that, to be able to project all the way down past the entitlement and actually construct it and stabilize of that building, and then bring it back to what the value would be at exiting the entitlement itself. And so it's less certain, right? Because you're still relying that someone's going to be willing to buy an entitlement deal at that point in time and then go through a 2 or 3 year process of actually constructing it. But it's just something to keep in mind if you want to step into a developer's shoes, is that you're really there's multiple exits along the way, and there's multiple future values that you need to keep in mind, and the debt is really what's going to constrain you in terms of being able to pull off those deals, because they're really only going to lend on the as-is value. Oftentimes you can only get an acquisition loan when it comes to a development play. Even if you understand the zoning code and you understand the approval process like the back of your hand, they're still going to probably say, the uncertainty, how do I know that, right? The uncertainty is too great. I can only lend you what the asset is currently. Which, again, is why you're probably better off looking for development deals that have existing assets on them as opposed to just vacant land. Right? Because you could still generate some short-term income on those existing assets while you're getting the entitlements. So just something to keep in mind.
Actually, we have to wrap up in just a minute.
We're done.
But I was actually just wanted to do one little follow-up on that. And Kendra, I mean, how do you view it? Is it just too difficult to back into that, future value of the entitlement? Because right, the value of the entitlement, what you're saying is based on the cost to develop plus profit. That's going to get your value there. But is it just too uncertain, or what's the kind of response to, I guess, Kris, with the difficulty of getting some kind of ARV type loan on inside of the process?
Yeah, I was gonna say, we've actually done one of those loans to one of our really, really solid borrowers who's a massive developer down in Los Angeles. And we have our own model that breaks that out and tries to figure out what that return is to a developer upon entitlement, and what they could potentially sell it for. And we did one of those loans, and I think that, we got a CBRE appraisal which actually gave a value of the as entitled value, but it had a structure on it, to your point. I don't think that we would do it for just a regular way vacant land deal, but if it had a structure on it, I think we'd be probably willing, given your experience and given your business plan and whatnot, to embark down that road on a loan where you get a little more leverage against the as is value, because we have a pretty decent view that the as entitled value is going to be a lot better than the as is.
Ask and you shall receive, I guess, right? You know this is all being recorded, right? No, I'm just kidding. We will consider that a commitment. Please give a big round of applause for our for our Lenny Penny And actually, so right now we are going to take just a quick break, about 10 minutes. All these gentlemen are going to be in the breakout